Types of ledger every accounting professional should know. Complete accounting guide. Hello everyone, and welcome back to the channel. If you're an accountant, finance professional, business owner, accounting student, or someone preparing for professional certifications, understanding ledgers is absolutely essential. Every financial transaction record in accounting eventually finds its place in a ledger. Without ledgers, preparing financial statements, tracking business performance, and ensuring accurate reporting would be nearly impossible. In today's video, we're going to discuss the types of ledger every accounting professional should know. We'll cover what a ledger is, why ledgers are important, main types of ledgers, examples of each ledger, how businesses use them in day-to-day accounting, modern computerized ledger systems. By the end of this video, you'll have a complete understanding of ledger classification and their practical applications. So let's get started. Section A. What is a ledger? Before discussing the types, let's first understand what a ledger actually is. A ledger is known as the principal book of accounts. After transactions are initially recorded in the journal, they are transferred or posted into the ledger. Think of it this way. Journal daily diary of transactions, ledger organized storage of transaction information. The ledger groups transactions according to accounts. For example, all cash transactions go into the cash account, all sales transactions go into the sales account, all rent payments go into the rent expense account. This classification makes it easier to prepare trial balance, income statement, balance sheet, cash flow statement. In short, the ledger is the backbone of the accounting system. Section B. General Ledger. Let's begin with the most important ledger. General Ledger, Goal. The general ledger is the must-have ledger that contains all accounts of a business. It stores information related to assets. Examples: cash, bank, inventory, accounts receivable, equipment, liabilities. Examples: accounts payable, loan payable, tax payable, equity. Examples: owner's capital, retained earnings, revenue. Examples: sales revenue, service revenue, expenses. Examples: rent expense, utility expenses, salary expense. Example: suppose a company pays a fast rent of $. Journal entry: debit, rent expense $. Credit, cash $. Then these entries are posted to their respective accounts in the general ledger. Why general ledger matters? The general ledger helps track account balances, prepare trial balance, generate financial statements, conduct audit reviews. Every accounting professional works with the general ledger regularly. Section 10. Subsidiary Ledger. Subsidiary Ledger. As businesses grow, tracking transactions in only the general ledger becomes difficult. That's where subsidiary ledgers come in. A subsidiary ledger contains detailed information supporting a control account in the general ledger. Think of it as a detailed breakdown. Example: accounts receivable, control account. Total balance, $1,00,000. But management wants to know: customer A owes how much, customer B owes how much, customer C owes how much. The subsidiary ledger provides these details. Benefits: better tracking, customer level visibility, improved control, easier reconciliation. Large companies heavily rely on subsidiary ledgers. Section C. Sales Ledger. Sales Ledger. The sales ledger is also known as the accounts receivable ledger. It records all credit sales made to customers. This ledger shows customer balances, outstanding invoice, payment history, credit limits. Example: customer A purchased products worth $. On credit. The sales ledger records invoice number, date, amount, outstanding balance. Later, when the customer pays, the payment is recorded against that account. Why it is important? The sales ledger helps businesses manage customer collections, reduce bad debts, monitor overdue accounts, improve cash flow. For businesses selling on credit, this ledger is critical. Section 5. Purchase Ledger. Purchase Ledger. The purchase ledger is often called the accounts payable ledger. It records all credit purchase made from suppliers. This ledger contains supplier details, purchase invoices, credit notes, payment records. Example: A company buys raw materials worth $10,000 from suppliers. The purchase ledger records. Supplier name, invoice date, amount payable to date. When payment is made, the balance is reduced accordingly. Importance. The purchase ledger helps businesses pay suppliers on time, track liabilities, avoid penalties, build strong vendor relationships. Effective management of this ledger supports healthy business operations. Section Choi, Cash Ledger. Batch Cash Ledger. The cash ledger records all cash receipts and cash payments. This includes cash receipt, customer payments, cash sales, loan proceeds, cash paid, salaries, rent, utilities, supplier payments, benefits. The cash ledger helps businesses monitor cash position, prevent shortages, detect irregularities, improve financial planning. Since cash is highly sensitive, maintaining an accurate cash ledger is extremely important. Section Shot, Bank Ledger. Choi, Bank Ledger. The bank ledger records transactions involving business bank accounts. Examples include deposits, customer collections, loan proceeds, transfers, receipt, withdrawals, vendor payments, salary payments, bank charges. Why business is needed. The bank ledger supports bank reconciliation, cash management, fraud detection, financial reporting. Accountants regularly compare the bank ledger with bank statements to ensure accuracy. Section Art, Private or Nominal Ledger. Shot, Nominal Ledger. The nominal ledger contains income, expenses, gains, and losses. Examples include income accounts, sales revenue, commission income, interest income. Expense accounts, salaries, utilities, insurance, marketing expenses, purpose. This ledger enables businesses to determine profitability, operating performance, cost control, effectiveness. At the end of the accounting period, balances from nominal accounts are used to prepare the income statement. Section 9, Digital and ERP-based Ledgers. ERP Computerized Ledgers. Modern businesses rarely use manual ledgers. Today, accounting software automatically creates ledger entries. Popular systems include SAP, Oracle, NetSuite, Microsoft Dynamics, TeamShop, QuickBooks. Thirdly, advantages: faster processing, reduced errors, real-time reporting, automated reconciliation, better data security. Although software performs the posting automatically, accounting professionals must still understand ledger concepts to verify accuracy and solve issues. Technology changes tools, but accounting principles remain the same. Conclusion. Let's quickly recap the types of ledgers we discussed today. General Ledger, Subsidiary Ledger, Sales Ledger, Purchase Ledger, Cash Ledger, Bank Ledger, Nominal Ledger, Computerized or ERP-based Ledgers. Understanding these ledgers is a fundamental skill for every accounting professional. Whether you're preparing financial statements, performing audits, managing accounts receivable, handling payables, or working with third systems, ledger knowledge forms the foundation of effective accounting. If you found this video helpful, don't forget to like the video, subscribe to the channel, turn on notifications, and in the comments below, let us know which ledger you work with most frequently in your accounting role. Thank you for watching, and I'll see you in the next accounting tutorial.